We're here with Erin Lowry, host of our Money Matters series. This is paying yourself on a variable income. It's a great topic, and I'm sure there's information that's going to apply to people at various levels of income. I saw the questions that came in. There's a lot of good stuff. With that, I'll just let you go ahead and get to it, Erin. Thank you so much for joining us today.
Thank you, Johnny. I am so sorry, everyone. No clue what was happening, but my computer decided to work against me today. So I just want to share a little bit right up here at the top. We got a lot of wonderful questions that came in, but I do want to reiterate a few important things for everyone. One, I am not a tax professional nor a lawyer. So while today's presentation will largely focus on the logistics of handling a variable income and also offer options for you for ways that you can handle that feast and famine feeling that stems from the finances of being a writer, to which I can deeply relate, I'm not giving you prescriptive advice that says unequivocally, this is the way to handle your finances as a writer. Also, because the answer to literally every personal finance question is it depends. And I'm going to try to offer multiple options for people in various stages and various incomes levels. And hopefully, you can take all of one solution or some of some solutions to create a new system for yourself. Now, there were a lot of questions that came in about which is better, S corporation or LLC. And frankly, I cannot answer that for you. It truly does depend on your unique situation, and it is best that you discuss the particulars of your situation with a certified public accountant, a CPA, or a lawyer, or both. However, I am going to dig in a little bit about how each one impacts the way that you pay yourself, and we'll review them a little bit today. So, one of the most common questions that gets asked in these conversations is what is the minimum yearly income required to either establish an LLC or another business entity, by which most people do mean S corporations. Unfortunately, there is no singular answer. You're going to hear rules of thumb. Some of them will say at least $100,000 or at least $250,000 or at least $500,000 in order for an S corporation to be worth it. I also just want to pause and say here that sometimes I will say S corp. Sometimes that sounds like another word, but I'm just going to say S corporation and S corp are the same thing. Now, according to Robert Pesci, who some of you may be familiar with from the tax webinars we've done in the past, he likes the rule of thumb of $400,000 that you are going to gross this year and that much or more in the forthcoming years in order to really see the benefits of an S corporation. Now, that is his rule of thumb. That isn't necessarily the right answer for every person's individual unique situation, which is why I say talk to a CPA if it sounds of interest to you. Now, an LLC might be worth establishing for liability reasons more so than for tax reasons. But again, you want to consult with an attorney about your specific situation. Sometimes people think an LLC provides a bit more protection than it actually does, because if someone's going to sue you for something you've written, they'll probably sue both your LLC and you as an individual. So, just something to discuss with an actual attorney. Now, from a tax perspective, there actually is not much of a benefit of being an LLC. A single member LLC files their taxes in the same way as if you are not an LLC. There's no difference in the tax result. Information is going on a Schedule C, even if you're just a sole proprietor of a single member LLC. Creating an S corporation would ultimately make you a W 2 employee because you're becoming a W 2 employee of your own company, even if it's just a party of one, which could make other parts of your financial life actually easier. For instance, if you want to be applying for a mortgage, you're a W 2 employee now. That's a lot easier than having to prove income from bank statements and multiple years of tax returns as a self employed person. But just because it's easier to do something like get a mortgage doesn't necessarily mean that it's the right financial move, because it is a multifaceted question. Now, just quickly before I move on from this conversation, I am going to drop into the chat a link to the webinar we've done before about forming an LLC and an S Corp. All right. I actually think, Johnny, you might have to take that and drop it in. Perfect. And there will be one other link that I share a little later in this presentation. So for those of you who are really interested in understanding the ins and outs of LLC versus S corporation, I highly recommend watching this webinar after this one or whenever you have the time. Now, first and most importantly today, I know I just threw a lot of information at you about business entities, but you do not need to incorporate your business to use a lot of the strategies that I am going to outline today. One of the most important things that I want you to take away, regardless of how you're structured, is to keep things separate. You want to keep your business and your personal accounts completely siloed. This includes being paid into an account that is earmarked for business income and business expenses, even if it is not a formal business account, by which I mean you didn't go to the bank and set up a business checking account. You should also have a credit card that you use just for business expenses. Same thing applies here. If you maybe are not in a situation where you can get access to a business checking account or a business credit card because of how you are set up, you don't have an EIN, you don't have an LLC, you're not an S corporation, and no one's willing to give you a specific business checking account or business credit card, what you can do is just create a personal version of each that you know is your business account. The reason this is important is the separation makes it so much easier to track business expenses at tax time and to take the appropriate deductions. It also is easier to handle any sort of audit that the IRS might do because it does legitimize what is on your tax return. And for me and the way my brain works, it just is incredibly helpful to have those things totally siloed. So when I look at my checking account for my personal spend, it's not conflated with the money that I need to survive for months to come or use for business expenses. And my personal credit card isn't commingled with business expenses that I'm paying. Because that really makes tax time a nightmare. Now, when it comes to business checking accounts, there are two main options that you can use. One, I'm going to call traditional, by which I mean an actual business checking account. You go to one of the major banks. I'm not endorsing, just using actual names like a Chase or a Bank of America, and you set up what they call a business checking account. Typically, it is easier to set one of these up if you have an employer identification number, an EIN, or a business entity such as an LLC or an S corporation. And you'd need an EIN to have those things anyway, so it kind of all works together. However, it is not necessarily a requirement to have those in order to set up a business checking account. Some banks will allow you to set up a business bank account using your social security number, even if you're just as a sole proprietor. So if that's something that you want to do, to have a very traditional, this is called a business checking account, you just need to reach out to the banks and see who would allow for that to happen. There might be a little bit more hoops that you have to jump through to prove that you're a business, but you can have that conversation with the bank. Just so you know, a sole proprietor can be eligible to get an EIN even if you work as a subcontractor. Now, you do legally have to separate your business funds from your personal funds if you decide to incorporate your business, particularly with an S corporation, and a business bank account is the simplest way to do that. Now, before you sign up for one, please be sure to do your due diligence, particularly about fees. Unfortunately, business bank accounts don't generally offer completely free services. There are certain hoops that you have to jump through in order to get a free account every month. For instance, where I have my business checking account, there will be a $15 monthly fee unless I have $2,000 in eligible deposits each month or a minimum daily balance of $2,000. Now, if you're in a situation where either you don't want to jump through the hoops of opening a business checking account because you're not legally required to do so, or maybe a bank said, we're sorry, we're not seeing this as eligible for a business bank account. Your alternative, particularly if you're a sole proprietor, is to set up just a classic bank account, a personal checking account that you know is being exclusively used for your business. Just a heads up, you can nickname through most banks and credit unions a bank account or a checking account or a savings account. You can alter it from saying like account number 567309 to specifically business checking account, business money, whatever you want to name it, so that when you log into your bank account, you know this one is for work, this one is for personal. It makes your life so much easier to keep these things completely separate, both physically and mentally. Are there any questions specific about these before I move on? I'm going to stop and pause instead of holding all of the questions for the end because we're going to have very specific questions along the way. And for the person who missed the suggested amount, Robert says $400,000. I will say later on, I have not grossed that much, but my CPA did still recommend I become an S corporation for various other reasons. So sometimes there might be a good reason that you need to discuss with your CPA about why it makes sense for you personally. And yes, you can have both an LLC and an S corporation. Can your personal credit get impacted? And what business credit card can you get? Your personal credit could get impacted. You could also be having your own business credit depending on how you're structured. So if you default on loans or credit cards, it could impact your personal credit much in the same way, depending on how you are structured. I'm not going to go into a whole lot about doing business as the DBA because I do recommend you speak to an attorney about a lot of this. I'm going to speak more specifically to LLC and S corporations in today. Any other questions specifically about business bank accounts before I move on? All right. So just to reiterate about the EIN, an EIN is only required for an unincorporated entity, even an LLC, if the entity has payroll, employees, or is treated as a partnership. You are required to have an EIN if you are an S corporation. And it is allowable that anyone can get an EIN, but it is only required if the author has employees or an LLC that has other members and is a partnership or is incorporated. So you may not need an EIN, but if you want an EIN and you think it's going to be valuable for other reasons, you could get one. Now, being a writer, as we all know, comes with high months and low months. When those royalties or advances are hitting, you might feel flushed with cash and you might go through a dry spell for an extended period of time. So for me personally, for instance, I know that next month I am projected to make 3 times what I did this month because next month royalties on 2 of my books are going to come in and the 4th installment of an advance on one of my books is going to come in. So I know explicitly how much I'm making off of those things in addition to other income I'll be earning. So that's going to be a boom month where the month after, I don't have a lot of projected income right now. And dealing with that, I'm sure we can all relate, can be incredibly stressful. And about 6 years ago, I realized that one of the best strategies for me personally to stabilize my financial life from month to month was to put myself on a salary. Now, this was years before my business was structured as an S corporation and I was legally required to run payroll. Having a regular paycheck that is self-imposed, regardless of your business entity, whether or not you have one, really helps because it is incredibly easy to overspend during those big months of income or to be trying to play catch up and covering all your bases from what happened previously. And then you end up stressing out about how to make ends meet during those low income months. In order to do this, you first have to determine and figure out a monthly salary for yourself, which in this case, I'm going to talk about it being the net income that you want to pay yourself after taxes and retirement contributions. And that'll help level out a lot of the chaotic feelings. We are going to get into paying taxes and setting aside money for retirement. Now, everything I'm about to talk about is not a 100% foolproof plan, especially if you go through a very sustained downturn. I'm talking like 6+ months. It is possible that you'll run very low on funds, but you can also always try to adjust the paycheck that you're taking as income to try to elongate your runway. And just for everyone who might be getting anxious listening to this, we are going to talk a little bit about this idea of reasonable salary and who that applies to. So, step one in all of this is figuring out how much you need each month. And I'm going to bring up one of my least favorite words, maybe one of your least favorite words, which is monthly budget. You have to figure out what your monthly budget is. Now, I want to be really clear about what that means. I think a lot of times when someone says budget, people just assume that you're taking in this concept of like, oh, I have to restrict how much I'm spending. In this case, that's not actually what I'm referring to. I am talking about what is the bare minimum amount of money that you need in a month to make ends meet. So this includes your housing costs, your utilities, transportation, insurance premiums, child and or pet care, food, medicine, personal care, personal products, household goods, toiletries, annual payments prorated, I'll get to in a minute, and your debt payments. How much do you have to pay in every one of those categories? Some of them might not be relevant to you. And that is the bare minimum amount of money that you need in a month just to break even, just to survive, just to not default on anything. So let's say hypothetically that number is $3,500. That amount of money just gets you by bare minimum essentials. Now, of course, we want to live more than our bare minimum essentials. So you might tack on an extra amount of money on top of that. Maybe you're thinking about savings goals that you're trying to accomplish on top of just wanting a higher quality of life. So let's throw on another $1,500 to that for a total of, let's say, we're looking at wanting to have $5,000 a month. Post tax is how much you need to live a comfortable life. For some people, that number might be way higher than their current reality. And for some people, that might be thousands of dollars lower than their current reality. But this is just a hypothetical. Now, let me see if I can screen share with you really quickly, just so that you can see this. I just want to show, here is how, when I said annual payments prorated, this is how I recommend handling annual expenses as part of your budget, even your bare minimum budget. All of us have annual payments that we have to make, whether that's homeowners insurance, car insurance, renter's insurance, car registration, credit card, annual payments, whatever it is. What I want you to do is take that amount of money that you're going to owe. So, for example, let's say for me that I owe $550 a year on renter's insurance, divide that by 12. That means roughly $46 per month needs to be set aside into an account for bills. So, I actually have, in the way I have my bank account set up, one of my banks allows me to create something called buckets. And I have a buckets that's just called annual bills. And I put that amount of money for every single annual bill I have aside each month so that whenever I have to pay one, I am not startled. It's not going to blow up my budget. I have the money already set aside. All right. Anybody have questions on all of that so far before I go to point 2 of your paycheck and putting yourself on a salary? So someone asked, just to go back to the EIN, should you have an EIN if you are paying contractors and subcontractors and need to send them 1099s each year? I would actually consult with a CPA about that because that might trigger the having employees clause. So I just would double check that with somebody who is a professional in taxes. If you have an LLC with an EIN, could you be a W-2 of your LLC? W-2 really only has to do with S corporations most of the time. LLCs are more just legal entities. And why would someone be required to have payroll? We are going to get into that a little bit, but S corporations are required to run payroll every single month. All right. So step 2, I'm going to be separating this out into 2A and 2B because I want to give options depending on any business entity that you might already have. So 2A, we're going to assume in this example that you are not an S corporation and you are not on a formal payroll system. When I say formal payroll system, what I mean by that is that you don't have QuickBooks or Gusto or something like that that pulls money from a legitimate business checking account and transfers it to your personal checking account every month and pulls taxes out and pays those for you. So if that is not your situation, if you are unincorporated, you're just working as a sole proprietor or a contractor or whatever term you want to use for self-employment, here's my recommendations. First, consider having 2 business-centric accounts, preferably a checking account and then a high-yield savings account. Your business checking account. Now, when I'm saying business checking account in this example, I don't mean a traditional business checking account. I mean, you could have gone to any bank, set up a personal account, and nicknamed it my business money. All your income, whenever you earn a paycheck, gets deposited into the checking account that you have earmarked for your business. There is no commingling of your personal assets with this income money. Then, every single time you get paid, I want you to transfer 30 to 40% of that paycheck to your high yield savings account that is also earmarked just for your business. And that's going to be called Uncle Sam's money or quarterly estimated taxes or my tax money or whatever you want to call it. But just so you have separation of how much money you actually have to work with to pay yourself and how much you're setting aside for taxes. Now, 30 to 40% might sound really high. And the reason I recommend this amount is twofold. One, I don't know where you live. I live in New York City. We have to pay city, state, and federal tax. So we have an extra tax compared to certain other cities. On top of that, it's a high tax rate. So I like to recommend, while most people say the rule of thumb is 30% to set aside for your paycheck to pay quarterly estimated taxes, I go higher and I say 40. Then anything that's left over after I paid my quarterly estimated taxes, back when that was my system before becoming an S corporation, I would then have, oh, there's this leftover sum of money that's going right into my retirement account. If you know that you want to be putting more money aside for retirement, kick that up to 45% or 50% of every paycheck you make gets put aside into this high yield savings account. Now, I keep stressing that term because not all savings accounts have been created equal. There are some banks that have savings accounts that have interest rates like 0.01%, 0.03%, 0.3%. Those are all trash, and that is not where your money should be, personally or professionally. I want any money that you have in savings that can be in a personal account that doesn't have to be in a business account in a high yield savings account earning right now at least 4% in interest. Is that going to make you rich? No. But if you have $10,000 that you have amassed in this account over the year, 4% of $10,000 means that you made $400 just in interest. That's an extra lump sum that you can be putting into your retirement account. It's an extra lump sum that can be going to pay off a business expense. So if you are in this bucket of people who are not incorporated and are setting up systems that are just traditional personal, let me take the word traditional out, who are setting up systems that are a personal checking account and a personal high yield savings account that you just mentally know are for business, take advantage of a high yield savings account. Then, after you have had your money deposited into that business checking account, moved a percentage of that money into your high yield savings account to be prepared for your quarterly estimated taxes. The next thing you're going to do is to run a self-imposed payroll. And you get to pick. Do you want to pay yourself biweekly? Do you want to pay yourself monthly? You could do weekly. It doesn't really matter. But let's go back to the previous hypothetical example of you're going to pay yourself $5,000 a month. That's the greatest lifestyle version that you're comfortable living right now. Then at the start of every month, you transfer from your business checking account to your personal account $5,000. And that is what you have to live within. Just like if you had a traditional job and you were earning your salary that way. Now, the advantage to also having your bare minimum number is so that if you know you're about to face a slowdown, or seasonally, you know that maybe summer is just always slow for you in your industry, you can just automatically drop down to only paying yourself $4,000, still giving yourself a little bit of a buffer. Or maybe you drop down to exactly how much you need, that $3,500, in order to just keep more money accumulating in your personal checking account. Again, this is designed to help you sustain during the slower months, but it's also designed to help you with your tax obligation and to keep things siloed so that come tax season, it's a lot easier for you to look back and actually see what you spent on your business and how much you earned, and not to commingle personal and professional assets. Any questions on this strategy before I move on to if you're incorporated? Where do you find high yield savings accounts when the interest rates aren't as high as they currently are? So, obviously, interest rates change all the time. It has to do with the Fed benchmark. I'm not going to go too far down that rabbit hole. But for instance, just to name a bank, again, this is not an endorsement, but Ally is up above 4%. For a very, very long time, let's say pre-pandemic, 1% or 2% used to be the gold standard of what you could get on a high yield savings account. Now, there are folks on this call that probably remember back in the day when like 8 to 10% was a really good deal. In my lifetime, it was 1 to 2% was a really good deal for a long time. Then we saw them drop down to about 0.5%. And then they kind of came skyrocketing back up. It's been kind of the only benefit of inflation, as we've seen an increase on high yield savings accounts. So there are all sorts of different tools you can use, websites that you can use to try to find the best ones that are out there. Personally, I don't just go for the one that's the highest. I go for also a bank that has FDIC insurance. That is incredibly important. And that I like the customer service and I find the user experience easy. So that's something to consider. So, okay. How much do you or how do you decide how much to put into your SEP IRA at the beginning of the year if you don't know what your income will be? Well, you shouldn't be deciding how much to put into a SEP IRA at the beginning of the year. You're not going to know how much you're allowed to contribute until the end of the year. I'm going to hold this question actually because we're going to get into retirement accounts later on. But part of the perk of putting money into that separate savings account and just having it set aside is so that you have it ready to go when you are ready to contribute. You might also have a sense of, I know I'll be able to contribute at least this much. So if you want to be dollar cost averaging, by which I mean putting some money in the market at consistent intervals over the year, and you know, like, well, I'm at least going to make $40,000 this year, then you can do the math on how much you're able to put bare minimum into your SEP. All right. I'm going to move on to step 2B. So this is distributing your paycheck if you are structured as an S corporation or on a formal payroll system. So for context, 2A is a system that I personally was running for a very long time before I became incorporated and became an S corporation. Once I became an S corporation, I was legally required to run payroll. Now, a big part of the reason that I have to do that is because of the taxes that I have to pay now that I am both my employer and an employee, technically of myself, because I own the company. We'll talk about that a bit more in the next bit. But first, I just want to talk about this distribution of your paycheck. If you are structured as an S corporation or on formal payroll, all your income first gets deposited into your business checking account. And when I say business checking account here, I mean an account that is set up and stated as a business checking account through a traditional bank. Now, this, of course, allows high income months to accumulate, so you can also sustain through any sort of low income months. Now, payroll is run to deposit your monthly salary from your business checking account to your personal checking account. Payroll is run by actual payroll software. I will describe those a little bit more in a few minutes, but it is important to know that there is actual payroll software you would have to set up. In this example, if you are an S corporation or incorporated in any sort of way that requires you to run payroll, you do not want to be using the Uncle Sam high yield savings account situation, because you shouldn't be moving your money indiscriminately into another account. Now, if you want to have a business savings account, which does not tend to be high yield, just to separate that way, by all means, just make sure that it's all under your business and a recognized business account, and you're not just moving money around, because that would look really weird to the IRS if you were to get audited. Retirement contributions also may be able to get made from your business account depending on your structure. So that is something you should discuss with a CPA. Now, how to determine reasonable salary. I'm going to read some jargon at you real quick. This is directly from the IRS. S corporations must pay reasonable compensation to a shareholder employee in return for services that the employee provides to the corporation before non-wage distributions may be made to the shareholder employee. Basically, what that mouthful means is that some folks who are structured as S corporations decided that they were not going to pay themselves a salary, and instead they were just going to pay themselves in dividends of the business revenue. And the reason they wanted to do that was because they wanted to bypass payroll taxes. The IRS makes a lot of money off of payroll taxes, and when they didn't get their cut, they got big mad. So they instituted this rule that you are required as an S corporation to pay yourself a reasonable salary based on how much you earned that year. The problem with this rule is that they didn't actually give us guidelines. They just said it had to seem reasonable. They didn't say a percentage. There wasn't, a bracket. There's not a great rule of thumb. So, the best way to determine a reasonable salary for your S corporation is to talk to a CPA, your CPA, and you two together can figure out what's reasonable. But common rules of thumb that tend to get used is that you need to pay yourself at least 60% of your business income. So, for example, if you earned $100,000 this year, you would have to pay yourself at least a salary of $60,000. The problem is, and we're not going to go too far down this, you might end up paying more in payroll taxes than you need to compared to if you weren't structured as an S corporation, which is why it is a very good idea to always talk to a tax professional to get advice on whether or not it makes sense for you. As a self-employed person, you are paying self-employment tax, which is about 15%, which is a high amount of money. And that's why sometimes people get excited at the idea of becoming an S corporation, because it changes how you pay that tax. You pay a portion as the employee and a portion as the employer. You're still kind of paying the same amount, it just gets taxed slightly differently. But payroll taxes that are being paid on running actual legitimate payroll and not just transferring money from your earmarked account to another earmarked account can really add up fast. So if you're not making a significant six-figure salary, it just might not make as much sense for you to do that. So again, consult with a CPA. Just going to pause here real quick before we move on to taxes. So someone asked, what is the best budgeting app for people like us who have variable income? It really depends on the kind of software that you want to use, but one that I do think is a great option is YNAB. You need a budget, YNAB, because it works on a principle of zero sum budget. So basically, you are using last month's salary to pay for this month's expenses. You're trying to get a month ahead, which can really help stabilize for people on a variable income. But again, I want to point out the fact that if you put yourself on a salary, the way I want your brain to start working is that you're not on a variable income, you are on a set salary income. You're just needing to earn enough to cover that salary. Someone asked, can you talk a little bit more about buckets? Does this mean you have allocated funds earmarked for different expenses? So again, I am not evangelizing for this bank, but I will say that Ally has a way that you can set up what they call spending buckets. This is more specific for savings accounts, but they do have them for checking accounts. So you can have, it might say at the top, like, there's $10,000 in this account, but let's say it's for your quarterly estimated taxes. And you say, of that, 7,000 is for taxes and 3,000 is for my SEP IRA. So it's not a requirement that that's how you spend that money, but when you click on that account, it will show like, this amount is saved for this amount is saved for this amount is saved for this. And I find that a very helpful way to visualize how I'm separating my money, particularly when we're talking about, annual payments or anything like that. All right. I'm going to move on to the next part and then we'll come back to some more questions. So, preparing for taxes. Being incorporated with an S corporation means you run payroll and you are paying taxes like you're a W-2 employee, in addition to paying taxes as the employer. So payroll software like Gusto or QuickBooks will help you set up a system in which your monthly paycheck has taxes taken out and paid just like with a traditional employer. So you will fill out a bunch of information about where you live and your tax bracket and your marital status and all of that. And that payroll software will make sure that your taxes are going where they need to go. In addition, it'll also help you pay kind of the employer side. It's not just city, federal, and state, depending on where you live. Maybe you just pay federal, but it could also be like FICA, Social Security, Medicare, all of that. If you are incorporated, an S corporation, also keep in mind that you file an annual return for your S corporation by March 15th, and then your personal tax return also has to get filed by April 15th. So that is preparing for taxes for folks who are incorporated. It runs way more similarly to being a W-2 employee. Now, if you are not incorporated and you are dealing with quarterly estimated taxes, those need to get paid April 15th, June 15th, September 15th, and January 15th. If the 15th falls on a weekend or a holiday, it would be the next business day. So let's say the 15th is a Saturday, Monday the 17th would be the day that your quarterly estimated taxes are due. Now, for anyone who is tuning in, who's like, hey, I work a traditional job. I have an employer, but then I also make money on the side as a writer. Do I really have to be paying quarterly estimated taxes? Maybe. You still need to make quarterly estimated tax payments or face a penalty, even if you work a traditional job, if you're earning enough. There is obviously a tipping point. So it depends entirely on how much additional income you are earning. In a season where maybe you're getting some advances and a royalty from a previous work all in the same year, that might be enough to tip you over. What you could consider doing is increasing your withholding information on your W-4 with your traditional employer. So you're having more taxes taken out of your day job paycheck to compensate for the taxes that you should be owing in quarterly estimated taxes. Ultimately, the IRS just wants their money. They don't want to wait till the end of the year for you to pay how much you should have been paying all year long. That's why we have to make quarterly estimated payments, or we pay a penalty if we fail to do so. And I have known people who prefer to just not deal with the headache of quarterly estimated taxes and take the penalty every year. It is your call. It just costs you more money if you're going to do that. Now, there are three options for calculating your quarterly estimated taxes. The first, estimate at the start of the year how much you're probably going to owe for the entire year. And then you just send 25% of that amount each quarter. So if you're like, hey, probably going to owe 10 grand this year, you're paying $2,500 quarterly. A lot of us do not have the foresight to know exactly how much we're going to be earning in a year. So that strategy can be a lot harder unless you have a very specific and consistent stable of clients that you're used to working with. Another option is to use the IRS worksheets that you can find on irs.gov entitled Publication 505 that can determine how much you're going to owe. I'm going to send that to Johnny. He can share it into the chat for everyone. So there's a link to find Publication 505. And three, my personal favorite, hire a CPA and work with them to help figure out your quarterly tax bill and then run your annual return at the end of the year. Again, I want to go back to the recommendation of setting aside 40% of every single paycheck that you make to always have that buffer set aside to pay your quarterly estimated taxes and or any penalties or unexpected tax costs. Plus, you might have some money left over for funding your retirement account. Now, I want to repeat that 40% strategy is for people who are not incorporated. Those are the folks who are paying the quarterly estimated taxes. If you are structured as an S corporation, you are paying your taxes on a salary throughout the year, just like a traditional employee. All right, and then finally, investing for retirement. I want to share this slide with everyone. Just think it'll be a little bit easier. All right. These are not the only three options for investing for retirement as a self-employed person, but it's the three we're going to talk about, technically four if you separate traditional and Roth IRA. Now, first, I just want to clarify, I use the term investing for retirement instead of saving for retirement. I find saving for retirement to actually be a bit of a misnomer. The reason I say that is because the money that you are putting into any of these vehicles should be getting invested. You need to be picking investments. If you're just dumping money into a traditional or a Roth IRA without picking investments, it could just be sitting there in cash, doing absolutely nothing for you to grow for the future. So
Excuse me, Erin.
please,
I
yeah,
don't think the screen share is working, actually. It says you started screen share. Yeah.
let me try again. Is it showing at all now?
Now it is. Yes. Great.
Okay.
Yes.
And how about now? I did play from current slide.
Yep. It's good.
Okay.
Thanks.
So for anyone who's concerned about what I just said about like, wait, was my money invested? The simplest way you can figure that out is to log into whatever investment portal you have, whatever brokerage has your, whether it's a 401k, an IRA, and look to see where your money is. Is it have the word money market fund or cash next to where all of your money is sitting? And also, has it grown significantly over the years? If the answer is yes, I see the word cash or money market fund, and no, it has not grown significantly, then your money is probably sitting in cash. You need to actually pick investments. So that is incredibly important when we're talking about this, which is why I like saying investing for retirement, not saving for retirement. That soapbox aside, here are four different strategies that you can consider as vehicles for your retirement accounts. One is traditional or Roth IRAs. The difference between these two is simply when the tax advantage happens. With a traditional IRA, you are taking the tax advantage now. Let's say that you're going to contribute $7,000, which is the maximum limit for people under the age of 50 in 2024, and you earned $87,000 this year. Well, if you max out by contributing the full $7,000 to your traditional IRA, that means it's going to adjust down your taxable income to $80,000. So you'll get a little advantage today. With your Roth IRA, it's the opposite. You are contributing money post-tax. You are not getting any sort of tax advantage today. But when you take the money out in the future, you will be able to take that money out tax-free because you've already paid taxes. Otherwise, it would be double taxation. There's no right or wrong answer about which one makes the most sense. It's really what makes the most sense to you for your tax planning purposes today. Oftentimes, the advice will be younger folks will better take advantage of Roth because they have a longer time for it to grow, while older folks, it might make more sense to lower your taxable income today. But again, there's not really a right or wrong answer. It just kind of depends. With traditional and Roth IRAs, there are income restrictions to receive those tax deductions on a traditional IRA, and there are income limits to even be able to contribute at all to a Roth IRA. There is something called a backdoor Roth IRA. We don't have the time to talk about it, but those do exist if you want to try to get around and go through a loophole. So for those who are under 50 in 2024, you can contribute $7,000 to a traditional or a Roth IRA. If you're 50 plus, you can do $8,000. That is the least appealing option of these three because they are the lowest amounts that you can contribute. With a SEP IRA, you can contribute the lesser of 25% of an employee's compensation or $69,000 in 2024. What does that mean? That means that if you earn $100,000 this year, then the maximum you can contribute to your SEP IRA is $25,000. That blows a traditional and a Roth IRA out of the water. So if you are earning more money and 25% of your income is more than $7,000 or $8,000, the SEP IRA or the solo 401k probably makes a lot more sense for you in terms of a retirement vehicle. The catch with a SEP IRA is that employees need to be treated the same as you. So right now, if you're a party of one, SEP IRA can make a lot of sense. But if you decide in the future you want to hire employees, you need to contribute to their SEP IRAs the same amount that you're contributing to yours, which you might not have the funds or the interest in contributing quite that high of an amount. Another option is a solo 401k, in which you could potentially contribute as both the employee and the employer. And in 2024, employees of companies, so even traditionally employed ones, can contribute up to $23,000 to their 401k, plus the allowable employer contribution. What I mean by that is if you've worked a traditional job and they're like, we have an employer match on our 401k plan, and let's say it's 5%, then it's an additional 5% that gets put in on top of the 23 that you're allowed to contribute. The catch with a solo 401k is it's only an option to you if you do not have employees. There is a caveat for if your spouse is your employee, but again, that's a different conversation. So those are three different vehicles that you could consider for investing for retirement. Again, figuring out which one makes the most sense for you is going to depend on your goals, how much you're able to put aside, how much you're earning, and which is most tax beneficial. I know I keep reiterating it, but talking to a CPA does make a huge difference for us who are self-employed. A lot of times, I know might seem expensive at first, but they usually do more than pay for themselves in the advice that they're going to give you. All right, so let me just see if we have any last questions. And before I get to those, I do want to say as well, if you are not ready to set up a business entity, that is completely fine. There are many reasons why having an LLC or an S corporation may not actually make sense for your specific situation and actually would not be advantageous at all come tax season. So even if a business entity isn't the way to go for you, my hope for you is that you still treat your money like you are running a business, which means keeping a business account and having a separation between your personal assets and your business assets, as well as paying yourself a salary. All right, going to get into a couple questions before the end here. All right, best advice for finding a good, reputable CPA. I would talk to the Authors Guild folks. I would look at, options for directories. Asking friends is always helpful. Personally, also, I always look for folks who have experience working with either self-employed individuals or with creatives. And if you go back into the webinars that I've done with Money Matters, we have had various different accountants and financial professionals on there as well that might be helpful for you. And ask them some very specific questions, like why or why not with an S corporation? What do you feel like the threshold is? Have you worked with people in my situation before? If you are filing jointly, it depends on kind of what your question is, but if you're talking about the specifics of, let's say, contributing to a retirement plan, I file jointly. I'm married, and my SEP IRA still gets treated like the exact way that I explained it. And a solo 401k, that information about your spouse is only relevant if you've hired your spouse, if your spouse works for you. Generally, you cannot have dueling retirement accounts unless you are traditionally employed and have a 401k at work. You might still be eligible to have a SEP IRA or a traditional or a Roth IRA on the side exclusively for your writing income, the income that's not coming from your traditional employer. Can you have more than one IRA, say a Roth and a traditional? You can own two separate ones. You just can't fund them simultaneously. All right, let me see if there's any other quick one that I can answer before we have to part ways. Payroll software, I would recommend. Gusto is great. QuickBooks, I've heard a lot of good things about. Again, asking for recommendations from people. And if you are incorporated, you should have a CPA, and your CPA might have a preference on which payroll software they think is the best. All right. Thank you all so much for tuning in today. My apologies for the technical glitch that we had in the beginning.
Not your fault. Thanks everyone for your patience at the beginning, though. Erin, thank you so much for that helpful information. And as always, feel free to get in touch. You can use the contact form on the Authors Guild or email staff@authorsguild.org. And we do have references and referrals that we can offer for various things. Yeah. Until next time, best wishes. Thanks, Erin. Thanks, everyone.